they say that 70% of our economy is the consumer, right? And so far, they've really been keeping up their spending. And as long as I think jobs hold in and wages hold in, they're likely to keep on spending too. But are there any cracks in this job market? Well, the number of Americans filing for first-time unemployment benefits increased last week more than expected, suggesting that the economy and the uncertainty over the Trump administration's tariff-led trade policies were maybe weighing on the U.S. labor market. So the 4-week moving average, which tries to take out and account for the volatility in the weekly data, that came in at 235,000, rising above the previous reading of 230,500. So this release is added to a series of reports released this week that point to a cooling labor market as companies grapple with uncertainty around Trump's tariff policies. Now, to pour salt in that wound, Procter Gamble said and announced today that it plans to cut 7,000 jobs as part of a plan that said which aims to accelerate growth. These cuts are going to take place over the next 2 years and represents about 15% of its non-manufacturing workforce. So should we be concerned, right? I want to know what my next guest has to say about it. Please welcome into the show, Mr. Luke Lloyd. Luke, thanks for coming on. We always talk about it. When is the consumer going to crack? And I think, I don't know if we did this with you, but about a month ago, we were still shocked to see how much the consumer was spending. And as it happens, they were spending a lot of money with student loan money. Now, there's been research since then that says that things have gotten a little bit better for the consumer, and they're actually seeing the savings rate tick up a little bit as of late. But still, this. I don't want to make a bigger deal out of it than it is, but it's something that we have to pay attention to, don't you think?
Well, savings rates might be ticking up a little bit, but it's interesting. So is actually credit card debt. So you could actually be packing away money while you're still racking up debt. So that's, again, doesn't really show you, I don't think, the full picture in some ways. But it's interesting, I think, from an investment standpoint, kind of what's happening is that you are seeing job openings fall to a 4-year low. You're also seeing a lot of federal and corporate layoffs happening at a big level, like you kind of were just mentioning with Procter and Gamble and other companies. And what's interesting is you still aren't seeing unemployment tick up yet. And the question you need to ask is why? Even though the job openings might be falling and some layoffs are happening, the ones that are still working aren't switching jobs as much. So back a couple of years ago, if you remember, the employees had the power, not the employers. So what you saw was the employees got kind of arrogant. Is like, if I'm not making money at my current job, or I feel like I deserve more, I can just go work somewhere else and probably get a 10 to 20% pay bump. Well, what's interesting right now is the mentality shifted a little bit. You know, those workers aren't quitting because they're loyal to the companies. They're scared to leave because that consumer confidence, like you mentioned, is on a decline, which is very surprising since we're at such all-time highs in consumer confidence just probably 6 months ago, right heading into the Trump election. So it's very interesting what happens when unemployment rises. Is the Federal Reserve going to care about unemployment rising or inflation more? In my opinion, I think the inflation question is beat. I know all these people make a big deal about tariffs. I've never been in the camp that tariffs will be inflationary. I think all the deflationary pressure from cutting back government spending is going to offset a lot of that inflationary pressure. So I do think we're going to hit a point where we'll see that unemployment that's at like 4.2, 4.3% rise. The Federal Reserve will get scared and you'll see lower interest rates, which is exactly what the Trump administration wants, is lower interest rates. And they will do whatever it takes, I think, to get interest rates lower for middle class America to keep them borrowing money, even if they're losing their jobs.
Well, that's that seesaw that the Fed has to grapple with, right? Jobs and inflation, right? If they start to see that job market weaken and they want to cut rates, but they can't because inflation may or may not be around the corner. I think the Fed's, I think, a little slow to the uptake here because I think they've been way too worried about tariff inflation, if there is such a word. But I think that, as you said, that might be a storm in a teacup. I don't think we're going to see as much as people say. We might see a little bit or one-off price increases, but as long as there's an alternative that you can, buy instead, I think a lot of that is overblown. And so far, even though some will say we haven't really had tariffs, we have had some tariffs. There have been an uptick in some of those things. But we did a story here about 2 days ago how 50 to 60% of those tariffs are large retail giants are demanding that China pay for, right? So it's not going to. It's not like you hear a 30% tariff that comes down straight to the consumer and the price goes up by 30%. It's minuscule compared to that 30%. Correct?
That's right. But from an investment standpoint, you have to think about, where can you actually make money from all of this happening? Is it the big, sexy tech stocks that everyone was addicted to for multiple years that just seem to continue to hit all-time highs until we had the tariff sell-off about a month and a half ago? Or are there other sectors that no one really pays attention to that are considered boring but are now a little bit more sexier? And the question I ask is, if you get lower interest rate environment, well, those long duration bonds might start looking a little bit better. But then you also take a look at stock sectors that are fueled by this AI implementation and this AI boom that kind of is overlooked. If you take a look at utilities, utilities are like at all-time highs. And no one talks about utilities. So if you do get this deflationary more environment and you have this AI boom that's using all of this electricity, all of this energy need, including 50% of the US energy grid that's still supplied by natural gas, utilities start to look very interesting. So, you always, hear the saying when stocks are at all-time highs, you should actually probably keep buying more because they're more likely to even hit more all-time highs. I think utilities, I was pitching it probably about 6 months, a year ago, which was actually a good spot to be. I think that will continue to be a good spot that's overlooked and many investors won't pay attention to, and you can get a nice 4 or 5% dividend yield on that as well.
Yeah, you're right, and I think as well as utilities, you did mention it for a second there, but if we do see an uptick in some of these, it's not going to be an uptick at the same time we're cutting rates. But if you do see an uptick in some of these bond yields, I mean, hey, 5.25%, 5.5% at some point in time does also become a little bit of a competition for some of your equity portfolio, right?
Yes. Oh, absolutely. But there's two kind of philosophies here. I think we're approaching a very, very big move in the bond market coming up probably in the next 6 months. And I think if I was a betting man, I think rates are going to be going down over the long term, but it could go upwards. And that's why you have to be very careful with some of these rate play yields because, as you know, we talked about it a couple of weeks ago, US debt just got downgraded, which I think was more of a political move and should have happened
Yeah.
4 years ago when we were printing 9, $10 trillion. But it's interesting because the perception is, especially with some of these trade tensions, if governments around the world don't want to own US debt and we kind of get downgraded like we did and credit risk becomes higher, you could see a huge rally to the upside in interest rates, which would completely wreck a lot of the equity markets and completely wreck some of those trades I just kind of mentioned. So I think you have to have a quick sliver of a trade mentality of like if it completely goes the opposite direction, be able to get out quick. But
Yep.
I do think that we are entering this deflationary lower rate environment, but just be careful sometimes.
I think we are too. I really do. All right, brother. Thanks for being on. Great to hear from you. Luke Lloyd, he's with the Lloyd Financial Group coming to us from Covington.